if you're thinking about different sources on how you can fund these, where am I going to get 65,000? Where am I going to get 90 or $180,000? Start thinking back to what we trained. Do you have an old 401k? Do you have a retirement account? If you do, let's make that into a self-directed retirement account. Once it's self-directed, now you can use your retirement money to make these kinds of investments, these kinds of loans. Okay. But it has to be self-directed. If you're unfamiliar with those at this point, let me know. I can send you over some training. We have a great relationship with a company called a Horizon Trust Company that does self-directed IRAs. Also, money multiplier, infinite banking concept policies. So your specially designed and engineered whole life policies. If you don't have one of those already, what are you waiting for? If you do, where is your money? Do you have any cash value available sitting in there right now? Let's tap into that cash value. Let's get that money to work. You always want your money working for you just as hard as you work to get that money. So let's get that money out there. Or do you have money sitting around somewhere in cash? So start thinking, do I have equity in my home? Can I tap into a HELOC, a home equity line of credit? Or can I do a home equity agreement like Matthew Sullivan and Quantum RE talked about yesterday? Do I have money sitting around somewhere else that's earmarked for something down the road where I can invest it now and have it grow for me while I'm waiting? Do I have an active 401k at work? If you're starting to get scared, we talked about the stock market's coming down right now. If you think that's going to continue to happen and you can't move the money out of the 401k, what you can do is take a loan from that 401k. The interest you pay back for that loan goes back into your retirement account, but it now gets that money out of the, in my opinion, risky stock market and gets it into somewhere you can control, something like this. So you can typically take up to $50,000 a time out of your 401k through a loan. So pull that $50,000 out, combine it with $15,000 in cash, and all of a sudden you're making pretty good returns on your money right there. So just a couple ways that you can do that, and different things to start thinking about. Where is my money? Do I have any lazy money sitting around? And where can I get my money to work? All right. So start thinking about that. And then we want to get into a little bit about evaluating the deals. And Jade is asking, can you walk us through our first deal to make sure we cross the T's? And yeah, Jade, let me get into that right now a little bit with you guys. So first step, you got to find an investor to work with. All right. So you got to find a deal that you want to lend your money on. So I'm going to do this from the perspective of a private lender. If you're lending your money, if you're a borrower and you're on here right now, basically you're going to want to understand the psychology and the mindset of what that lender is going through. So that way, as a borrower, you know how to sell your deal, right? If the deal makes sense, it shouldn't take much, but life is a sale, right? Everything in life is sales. You know, from when you first meet somebody and you go on your first date, what are you doing the whole time? You're selling yourself, right? So there's some people out there. I used to do some sales trainings. I don't love it, so I don't do it anymore. But you know who does a really good job with sales training actually is Justin Colby. If you guys don't follow Justin Colby on social media or subscribe to his emails, you guys should do that. I think it's justincolby.com. If not, just put it in so you guys understand how to spell it. Just Google Justin Colby. He'll pop it up. He's an investor out of Phoenix, Arizona. We've done a lot of trainings with him in the past. He's a real big wholesaler, but he's great on training. He does a really good job in sales trainings and teaching all that stuff. So follow him if you guys want to learn more about sales. But so if you're a borrower on here, just kind of understand what a lender goes through. All right. So first step, number one, is you got to find a deal or an investor to work with. All right. So the way that we all do this is through the Private Money Club. The Private Money Club is going to introduce you to people like Steve Lawson, people like Michael Kurz, people like Kevin, people like Chris Rude, you know, and I'm sure I'm missing people right now. We have a ton of seasoned investors that have joined the Private Money Club. Devin Burr, last Monday, you guys remember I talked about 3 of Devin Burr's deals. I think one was like 45, one was 100, and one was like 160. All 3 of those got funded from that webinar that we did Monday by Wednesday through you guys, through people in the Private Money Club. So Devin Burr, and you know what he told me? He's like, man, I can't believe I never thought about using the Private Money Club to get funding for my deals. Because that's the easiest time I've ever had getting funding for my deals. And Devin does a lot of deals too. He does a great job with them also. So number one, find the deal. So we do it through the Private Money Club. Number 2, like I was talking about a minute ago, then what we want to do is let's figure out who that borrower is. So I always start there because it could be the best deal in the world. It could be worth $100,000 with no work needed. Buy it for $30,000. Nothing could go wrong. It's a perfect deal. But if I don't trust the borrower, it's a no deal for me. Okay. I got to understand who the borrower is. And that's going to set up the rest of the stuff for me. Because again, like I was saying a second ago, what we're looking at with a borrower is risk. Okay. Is it high or is it low? So what are some factors that go into risk when we're looking at a borrower? What are some factors that I want to know about the borrower that is going to either increase risk or lower risk when I'm evaluating a deal? All right, let's see. How many deals have they done? Time doing it, experience, how long in business, previous returns. Absolutely. Previous returns is a good one, Sean. Thanks for saying that. So yes, what is their experience? How long have they been doing this? How many deals have they done in the past? And how many deals are they actively doing? Just because somebody flipped 100 houses in 2005 doesn't mean they know how to flip houses in 2021. Markets change, times change, right? So when did they do all these deals? How many are they actively doing now? If they're doing 3 to 4 deals a month, did they just ramp up to that where they're maybe taking on too much? Or have they been doing 3 to 4 deals now for 3 years and this is just common business? They constantly are rotating through 3 to 4 deals, right? So previous returns and success rate. Absolutely, Liz. So then it asks, well, out of those 150 deals that you've done over the last 3 years, how many of those did you lose money on? Okay, you lost money on 5 of them. Out of the ones that you lost money on, what happened to your lenders, right? What happened to your private lenders? If your private lenders lost money as well, maybe. I know a lot of investors, Chris Rude, for example, that even if another guy that does a great job of this is Jack Petrick. These guys have lost money on deals, but guess what? They've always made their investors whole, meaning they've always paid their investors even when they lost money. So is that somebody that you would want to do business with if they've done that in the past? Again, it's no guarantee that they'll do it in the future, but your reputation in this industry is everything. So guys like that are showing me they want to make sure they have a reputation that's as high as it can get. And if they're paying money out of their pocket to make their investors whole, that says a lot about that person. Would you agree? So that's the stuff that we want to look at. And Jade said integrity. That's a great way to look at it right there. Integrity. I love it. So that's what we want to look at when it comes to who's that borrower. And then right here, checks off, checks off, checks off. I like it. Okay, I'm happy with this. But I'm keeping in the back of my head, what is that risk level? Is it high or low? Because depending on if it's high or low, that's all going to come into the negotiation of the terms of that deal, okay? Number 3, deal. So if everything checks out with the investor, with the borrower, then let's take a look at the actual deal itself. What are some things that you might want to know about that deal? Or what are some different pieces of information that you're going to want to see? Type those in the chat box. The ARV, okay. So the ARV is after repair value or after rehab value. So what that means is if he buys it for $60,000, puts in the work that he needs, let's say it needs a roof, it needs paint, it needs a new kitchen. What is that home worth after all the repairs are done in that property? So that's the after repair value. That's typically going to be what the property is going to sell for as well. Okay. So the after repair value, what it's worth after all the repairs are done. All right. So Farzaneh says, if it looks logical, yeah. So that's going to be looking at and evaluating these numbers that we're talking about. Colleen says how they pay. Okay. How they pay is going to be more in the terms. So we'll get to that in just a second. First, we want to look at the deal itself. So comps is a big one. Comps are what are going to support the the ARV, the after repair value. So if we say that that house is going to be worth $90,000 after repairs are done, and that's what it can sell for, why do you think it's going to be worth that? How do you come to that number? That's what the comps support. So the comps stand for comparables, comparable market analysis, CMA. In the commercial world, it's known as a BPO, a broker price opinion. These are all names for comps. What is the property worth? Comparing it to the other properties in that same area that are similar to that property. So if we have a 3-bedroom, 2-bath, 2,000 square foot home, we're not going to compare that to a trailer, for instance, a mobile home. We're going to compare that to other 3-bedroom, 2-bath, around 2,000 square foot homes within the same area. We're not going to compare a 3-bedroom, 2-bath, 2,000 square foot home in the next state over, right? It's got to be within the same area with everything basically the same. Now, if it's 3-bedroom, 2-bath, and the only thing comps are 2-bedroom, 2-bath, and 4-bedroom, 2-baths, then there's different calculations we can do that will adjust the price to make up for the extra bedroom or the no bedroom, or if the home has a pool versus not having a pool, or little things like that, right? But mostly saying it's got to be very similar. So that's the comps. So the purchase price and the reno costs, absolutely. So how much are we buying it for? How much rehab are we putting into it? That's all stuff that we need to know. Yeah, do they have a buyer? That's actually a pretty good one. That kind of combines this and this right here. You know, do they already have somebody in place that's ready to buy the property? And you see that quite often, especially in markets like we have right now that are very, very hot. A lot of these investors, they have lists. They have buyers lists, people that are specifically looking for houses. And if they're very good, they have strong relationships with realtors in the area that know that they provide this type of housing to the community. And these realtors are always staying in contact with the borrower, asking them, hey, what houses do you have coming on the market? And 9 times out of 10, these realtors will know, and they'll tell their clients, hey, this investor that I know is rehabbing a home right now. Let's go take a look at it. It's not done yet, but come take a look at it, because as soon as it's done, it's going to sell very, very quickly. And let me ask you this, as a borrower, how would you like to know that as you're doing the rehab on that property, as soon as you're done, you have a buyer in place ready to close on that thing immediately? How many of you would like to know that? Absolutely, right? Because that way you're going to put that freaking fire under your contracting team and say, you guys better get the damn thing done, because I got a buyer waiting and I need to make some money so I can pay out my investor and make my profits and move on to the next deal, right? So speed of how long. So that's the other thing with the deal. How long is that property going to sit on the market? What is that area? Are homes selling? What's the average days on market for a home that's priced right in that type of asset class? You know, if it's a middle class single family home for a family in a family neighborhood, what's the average for that area that the property is going to sit? That goes into holding costs and all that. But so all very, very important stuff. And so what we've done through the Private Money Club is almost all of the borrowers, all the investors are required to complete something called the perfect loan proposal. Okay. So the perfect loan proposal is going to give you all the information about the borrower, everything from their experience to who their team is, to how long they've been doing this, to other deals that they've done. And in a lot of cases, even inside the perfect loan proposal, the borrower, the investor will put their credit history. So they'll actually pull their credit reports and they'll put those right inside there. They'll show you bank statements. They'll show you their business accounts. So you'll see anything that the bank would require is what will be in this perfect loan proposal. So you as the lender will have everything you need to know about this investor, okay? And then obviously you set up a phone call. You can talk with them about it, ask them questions, have them clarify things that are in there. So you know everything you need to know. That's all in the perfect loan proposal. And you'll notice the perfect loan proposal is broken up into 2 sections, the borrower section and the deal section, okay? So when you start looking at these perfect loan proposals, you'll see it's clearly broken up into these 2 sections. And Steve, for instance, can send you both together or separately, depending on what part of the stage that you're in. So that's what we want to look at right there. So that's why it's very important to understand these 2, because that's everything that you're going to see within the perfect loan proposal. And then from there, if everything checks off, okay, we like the way the deal looks, or the way we like who the borrower is, we like the way the deal works, it all makes sense. You know, what their what the private money loan is, what the amount is, makes sense for what the ARV is, which is supported by the comps, and then the days on market. Again, do they have that buyer in place? Like somebody was saying, how long are they going to have that property? So as Steve was saying earlier, for example, 3 to 4 months is what they're seeing right now from when they buy the property. So they buy the property, they do the work to it. What do they do when they do work? They increase the value. So they buy the property, they increase the value, and then they sell the property. So they profit out, they cash out, they sell it, they close it, whatever the exit strategy is. And you'll see different exit strategies too. So for Steve Lawson, his exit strategy is he buys, he fixes it up, and his exit strategy is to sell retail. You'll see some of our other investors, for instance, Devin Burr, he buys, he fixes up, and then he refis it at the bank. And that's how he cashes out his investors. He refinances traditionally through a bank, which is known as the Burr method, BRRRR, buy, rehab, refinance, rent out, and repeat. So that's the strategy he's following. Michael Kurse, who you'll see come on some of these, he's an investor, a borrower within the Private Money Club. He has a 5-year exit strategy for all his deals. So if you invest with him, you're at 5 years, you're in with him, but it's a different exit strategy. So that exit strategy is what's going to be about with this deal right here, 3 to 4 months is what's expected from start to finish. So the deal, the rehab, the exit strategy, and that's what's going to give you all that stuff. Once you know everything, all the numbers, you know everything about the deal, then that's when we get into the terms. Okay, which I'm going to move into now. I'm going to erase this board, and then we're going to get into the terms. Any questions on any of that stuff? And real fast, Jade is asking, does the Money Club vet borrowers? We do not, Jade. It's very important to always do your own due diligence on all of everything that you see in the Private Money Club. However, you can talk to other members. As you saw on here, we had Jean, Colleen, and Belinda, I believe it was, that have all done deals and are very happy working with Steve Lawson. So you could talk to other people. What is your experience within the Private Money Club? You know, who are they working with? As I said, how do I know Steve Lawson? Through Steve Richards, who vouched for him. We've known Steve Richards for years. He's an incredible business guy in the Indianapolis area. So through the network, it starts to, it vets somebody as well as you can vet somebody. Does that make sense? So I'm not going to ever tell you it's 100%, but would I feel comfortable with somebody like Steve versus somebody I met at a random meetup or real estate association meeting, you know, that I knew nothing about or had nobody to vouch for him? Yeah, I would trust Steve a lot more in that scenario, right? So it's all about risk levels. There's never 100%, but it's always risk. All right. So that's all stuff that's going to lower my risk when I'm looking at evaluating who that borrower is. Ethan said, have you ever had a good borrower pass deals with you, bring you a specific deal that was too risky for you? It's I wouldn't say too risky, Ethan. It would be more, it just does not fit what I'm looking to do right now. So for instance, I've had investors bring me deals, but they want me to lend my money for 2 years to them because it's a bigger project and more extravagant. And it's just, that's what's needed. I need to lend my money for 2 years. At the time, I was not in a position to lend that kind of money for that length of time, even though I knew that investor very, very well and trusted him 100%. The deal just wasn't right for me at that time. So it's not a risk factor as much as I would say it's just a timing factor, right? Is the timing right for the deal? So hopefully that helps, Ethan. So let me delete this and we're going to get into terms. So once we have decided we like the borrower, once we decided we like the deal, once we decided, okay, this makes sense, I like the timing of it, it makes sense for my situation. Once all of that is checked off, right? Then that brings us to the terms of the deal. Now, in Steve Lawson's case, what you guys tell me, what are some things that go into the terms? Like what are terms, right? All right, what are some things that go into the terms, you guys? What would you want to know about this deal? If you were going to lend your money on a deal right now, what would you want to know about it? Okay. First off, how much, right? So how much am I lending? And then does that cover purchase, rehab, holding costs? So how much money am I lending, right? So does that cover the purchase of the property? Does it cover all the rehab as well? Does it cover the holding costs? The other thing, skin in game. Some people, depending on who the borrower is and what the deal is, they want the borrower to have some skin in the game as well. So basically, and what I'm saying by that is, let's say let's say it's $120,000 total for the purchase price, the rehab, all the close, all the holding costs, everything that goes into that deal. They need $120,000 to make that happen. Are you willing to lend 100% of all of that? Or do you want that borrower to have some skin in the game as well? Maybe you want to borrow, maybe you're willing to lend 100,000, but you want that borrower to have 20,000 of their own money in that deal as well, right? So how much are you lending? What does that cover? And does the borrower have any skin in the game as well? Or are you funding 100%? Again, it depends. What's that risk level? Who are you working with? What are the deals? You know, all that stuff goes into all this that I'm talking about. We already know all that. So we have an idea in our head. What is that risk level? What am I willing to do? And then the terms are all negotiable. Number two, what else would you want to know? Let me see. Interest rate. Absolutely. All right. So interest rate could be annual interest, right? So I'll just use Steve Lawson as the example since we just went through his deal. So he was offering 10%, or so another way, instead of interest rate, you could be profit. So in his deal, he's willing to share in the profit. So sometimes instead of paying you a flat interest rate, they'll pay you a profit of the deal. So in this case, 20% profit. In Steve's case, it's whichever is higher. So that's the other thing is how much, by me lending $120,000, what am I getting back as my return for lending you the money? That's what the interest is. And the other thing that you can look at, it's usually either written out as an annual interest rate or a profit on the deal. The other thing that you'll see come up a lot is what's called points. Okay. Points are a flat interest percentage point on the overall lending amount, no matter how long the money's lent out for. So what I mean by that is if I lended $100,000 at 10% and my money got returned to me in 6 months, let's say from when I lent it out to when it closed, I got it back in 6 months. Well, I'm not making 10% of 100 grand. I'm making 10% annual return. So if it's paid back in 6 months, I made $5,000. Does that make sense? Because it's 5%, which is half of 12 months. You know what I mean? So I made $5,000 on that. Now, what points are, 1%, 2 points, 3 points. So points are just 1, 2, 3%. Points are what you'll hear the most, 1, 2, 3 points, or none. A lot of the deals in the private money club don't have points. It's a risk thing. If I'm dealing with a new investor, I'm going to charge them more points because it's fine and dandy to know that I'm going to make this. But if it's not worth it to me to make 10%, if they're going to return my money in 3, 4, 5 months, maybe I want to know that I'm going to make a better return, even if they return my money quickly. And the way to do that is through points, because what points are is if I do a $100,000 loan and I charge 2 points and I get my money back in 6 months, I'm still making my full $2,000. Oops, you guys can't see that. Sorry. So if I'm lending, anyways, you guys get the idea. So if I'm lending $100,000 at 2 points, even if I get that $100,000 back in 2 months, they still owe me the whole $2,000. Okay. So the interest amount and the points can be worked out together depending on the deal, and points are negotiable. All this stuff's negotiable. Like I said, it's good to take sales courses because this is all stuff you're going to be negotiating back and forth at times. But the nice thing is, if you're dealing with we call them seasoned investors, experienced investors, somebody like Steve Lawson, somebody like Chris Naugle, like they know that they have 10 different lenders they could go to get money. So a lot of times they're not really willing to negotiate. They might be able to make some different changes, like he said, and how the money's paid. Like some people want interest paid monthly. Some people don't mind waiting till the end. Like it just depends. So there is some stuff there, but odds are Steve's not going to say, you know what, I'm going to give you 2 points on top of the 20% profit, because he doesn't need to. But if it's another investor, if it's higher risk, then you say, hey, I want points on this deal if I'm going to do this. And that's very, very common. And you see points on mortgages from the bank. If you guys have ever bought a house, I mean, there's points on that deal. You can see them. A lot of times the mortgage brokers build the points in because that's how they get paid, right? So it's very, very common when it comes to loans. All right, so what else do we want to know about the terms? How about length? Oh yeah, Farzaneh wrote it there, length of term. So how long are you lending the money out? So I'll give you an example on a Chris Rude deal. Chris Rude's deals are set up for a 12-month term. Okay. Meaning he's going to pay out 12% annual interest for a term of 12 months, meaning he has 12 months that he can take to return your money before defaulting on that loan. Okay. However, how long does Chris Rude deals typically take? 3 to 4 months. So just because the term is 12 months, that's what he has to perform by. However, can he pay that back sooner and can he close out that loan sooner? Absolutely. And in that case, 12% interest, $100,000 loan, you're basically getting $1,000 a month until you get the return of your investment return. So in that case, 100,000 goes out. So again, right here, the amount, $100,000. The interest rate is 12%. The length is 12 months. So what's going to happen is your $100,000 goes to Chris Rude. He pays you $1,000 a month until the deal closes, and he returns your $100,000 back to you. Plain and simple. Very, very easy. Right there. Amount, interest rate, length of term. So those are all the terms in the deal. And then all of this stuff. Any questions on any of this? Let me erase. If you guys have any questions, put them in. Okay. Now, we've evaluated the borrower, the deal, the terms. Once we have all of that figured out, then where does all this stuff go? Right? So how does that work next? Now what? Okay. So here's where the legal part comes in. This is where the protections come in. This is where, if you're working with a seasoned investor, a lot of times they have these documents ready to go. They use them over and over and over again. If you're not comfortable with that, have an attorney look it over for you. Who pays for the attorney? That's all part of the negotiation. A lot of times, if you're lending your money, you can say, listen, I'm willing to do this, but you're going to pay for an attorney for an hour or 2 hours of their time for them to review all the contracts and make sure this is legal. It's going to cost $300. That comes out of your side, or whatever the case is. Again, that's part of the negotiation. But what does that look like? So number one, you have a promissory note. Now, we talked about this in a training a couple of weeks ago. So if you missed that training, I went through a couple sample promissory notes and mortgages and pointed some stuff out on how they work. So go to Chris's YouTube channel. So YouTube at the Chris Naugle. Or just type the Chris Naugle. Make sure you subscribe and ring that little bell that's on there. It'll get you notifications whenever we put up new trainings. But all of these trainings that we do on Money Club Mondays are put on a playlist on Chris's YouTube channel. So you can go on to the playlist Money Club Mondays and watch the training from 2 or 3 weeks ago when we went all through promissory notes and mortgages and how these works. But I want to go ahead and show you the basics of it right now while we're still on here. So number one is going to be the promissory note. The promissory note highlights the terms. So everything we just talked about, what those terms are, go into the promissory note. The promissory note basically is a promise from the borrower. That's a legal document that they sign off on that says, here's how much money you're lending. Here's how much I'm going to pay you for that money. Here's how long I have to pay you back. Here's how that money is going to be paid back, whether it's monthly interest, whether it's just one big balloon payment at the end of it, whatever it is, all of that goes into the promissory note. Okay. The promissory note is then connected as a legal attachment, as a legal document to the mortgage, or what's known as the deed of trust. Okay. So the promissory note is attached to the mortgage or the deed of trust. The mortgage or the deed of trust is just like any mortgage that you've ever signed when you bought a home before. It has all of the legal mumble jumble important stuff right inside of there. So that document's very, very important. Again, if you're in the private money club, we do have sample promissory notes. We have sample mortgages and deeds of trust that you can take a look at to use as templates or start getting a feel for them. But you do want to have somebody look that over for you. Now, once you get a good one that you're using over and over, I don't see a problem. That's what we do with these things. You can use them, but please have an attorney look it over. I don't want to be responsible for that. So make sure you guys do that. I did talk with Brent Carlson. A lot of you guys know him with Corporate Capital, and he's working on putting together a little package for anybody that wants to do this stuff. He'll be right there to help you out with all this stuff. So I'm talking to him this week about that, and I'll post that up in the Private Money Club for you guys as well. So once we have the promissory note and the mortgage with all of that information in there, all the terms, everything about the deal, what's going on, this is what will put you in the first lien position. So the first lien position, again, gives you first right to take that property in the case that anything in the promissory note or mortgage is not done by the borrower. If anything in there, if they default on anything, they don't follow along with what is stated in here as the first lien position holder on that mortgage, you can now foreclose and take that property over. These documents do need to be recorded at the courthouse. So you need to make sure that the escrow company, the closing agent, the attorney, whoever is closing this deal, that they are recording this at the courthouse as well. That's what makes it all officially legal and gives you the rights as the lender to be able to do what you need to do in the worst case scenario. Okay. A couple other little things that you're going to want on there. You're going to want to make sure that you as the lender, this will be in the mortgage document, that you as the lender are listed as additional insured on the subject property. So that way, if there's a fire, if there's a natural disaster, if some contractor on Friday afternoon was drinking beers at the job site, got tired, forgot to unplug something, lightning hits and fries the place or something like that, right? Whatever, things happen in real estate, right? In life, that you're protected. If that home goes up in flames, you're still protected because you are listed as additional insured. So what would happen there is you call the insurance company, hey, I'm on this insurance policy, you know, the house just burnt down. I need to make sure that I get my money back on that deal. So make sure that you're listed there. It gets recorded at the courthouse. Everything's done. Also make sure, you know, once all this is completed, once all this is signed, once everything is done with the attorney or with the closing company, then you go to step 3. That's when you go ahead and you're going to wire the funds. And when you're wiring funds, there's a couple things to be very, very important. So first off, you never want to send money to an individual. Remember, you're always going to loan money to a company, to an LLC, to a corporation, never to an individual. And that's just due to like all the rules, Dodd-Frank rules and things like that that regard private money lending. So you never want to be caught lending money to an individual, always to a company. Also, you never want to wire funds directly to a person or a corporation, like to their account. You always want to wire the money through the escrow company or the closing agent, the closing attorney. That's where you want the money to go. Let the escrow company, let the attorney make sure that it's facilitated properly. And that way everything is done correctly, because that escrow or attorney is not going to accept the money if they don't have everything right with the promissory note and the mortgage and the deal itself as far as the closing goes. So you always want to make sure you're sending your money to an escrow or a closing attorney only. And that's just additional things that are going to protect you and your money. So Jade's asking to be clear, you're recording the deal in the state of the deal. Correct. Yeah, it's going to be recorded at the local state, at the local courthouse in whatever county or town that property is located in. All right. So just to recap one time, I know we're going a little late here, so thanks for sticking with me here, guys. When we're evaluating deals, we look at the borrower, we look at the deal. Those are on the perfect loan proposal. We negotiate the terms. Those terms go into the promissory note, which is connected to the mortgage, which gives you protection on your money by doing all these proper things, recording at the courthouse. When you're sending your money, always never to an individual, always to a company only, as well as making sure it goes through the escrow or closing attorney.
All right, if you like that video, make sure you check out this video right now. And also don't forget, subscribe to my channel and don't ever forget to smash that alert button. We'll see you on the next one.